Hi, everyone. I appreciate you hopping in to view this quick start guide to understanding real estate syndication. This is a class we provided for a couple different groups, and I thought I'd share it here so more of you can get it and just kind of get a feel for what we're talking about with real estate syndication. It's a question that comes up a lot with a variety of real estate investors, especially ones who haven't worked on maybe bigger multifamily deals or RV parks or things where you really need to bring in more partners and people to the mix. So we're going to go through these pieces fairly quick so it's digestible. And I am certainly available for follow-ups if any of you guys have questions afterwards. So a little bit about myself and my wife, who are the general partners with Gorilla Capital Partners. We've been around real estate for almost a couple decades now, and started off like many investors with single family houses, moving into some fix and flips, wholesale, a variety of different things. And then as we started to expand that, we were fortunate enough to get some good guidance from people who are really experienced in the syndication space. And in this particular scenario, it was some of the people over at the real estate radio guys, a great group of people over there. And they kind of educated us a little bit in some of those pathways. And from there, we started just growing and learning and asking a lot of questions and getting involved in more deals ourselves, which leads us to where we are now. So at the core of real estate syndication is really about creating a win-win partnership and making it to where you can leverage the general partners in a deal and a limited partners, and how you guys can expand on the size of opportunities that you could normally wouldn't be able to do by yourself, but you're able to do with some extra help. So what that really looks like is pooling resources from multiple investors for a real estate project. So here's the agenda we're going to go through. We're going to go through some typical structures, some of the benefits of the syndication, a little bit of the legal highlights, sourcing due diligence, some of the financial analysis, and we'll talk about one scenario on a specific case study or a case study in the area that I think makes good sense for people to look at the arms around what the numbers actually look like. So typical syndication structure, we're going to have a project property, and that property is typically put together in an LLC, or it could be apartment ABC LLC or whatever. The point is that company is the entity that will own the property. And then what you have on one side of that is the general partners. And the general partners, these roles will be everything from sourcing and finding the deals and putting up earnest money and project management, construction, and then people who are just bringing some of the money to get the project started. The way I look at that is this is kind of your sweat equity group piece of this. So these people are kind of making it all happen. And then on the other side of it, we have our limited partners. And this in short is the cash. This is a group of people who have assets to invest, and that could be from savings, 401ks, IRAs, a variety of different sources. But the main thing is these people are coming into a project. They're not managing anything with the project, but they are injecting capital. And ideally, the deal should work where these people get a good return. It's a return that's acceptable for them. A lot of times it could be higher than what they might get in another avenue, like a stock market. It's really kind of an evaluation for each person and what they feel comfortable with. And then the general partners managing that project and as well as those assets. A lot of times, this is a very generic example, but you'll see anywhere from 20 to 30% ownership in, say, a typical multifamily, to where the general partner will own 20 to 30% of this company in this case, or the project. And then the other 70 to 80% is the equity or the money ingestion. So these people are investing whatever amount of money that is for, say, an 80% ownership in the company. And that's kind of a very generic way it looks, and some of those will vary a little bit, but that's gets people in the ballpark of what a lot of the deals are going to look like. So why syndication? What are the real benefits? I'm going to take this in two pieces. First, from the general partner side of it, is access to larger deals. If you're trying to do deals by yourself, I can speak from example of buying the assets and managing them. frankly run out of money. You get to a point where you don't have any more money to go and acquire these other properties. You've got the bandwidth and the management bandwidth and the capability to run more projects, but you don't have the capital. And you're looking for the capital to invest in these opportunities. So there's a few ways you can make money on that side. You make it by your ownership in the project, some fee structures, profit sharing is the ownership in the project. And so it really allows people who are the operators or the people looking for these deals to scale their investment capability. And from a limited partner side, probably the biggest one is an access to professional management to be involved in real estate projects, which they may not otherwise be able to invest in, or may not have the experience or background enough to invest in those deals. So it allows some diversification of assets, ability to get into some bigger deals, and obviously your returns are, whether it be cash flow from the operations or distributions. Kind of a way to think about those is like if you're investing in a stock and you had a dividend paying stock, it's kind of the same type of deal. And then some risk mitigation, because you're relying in this case on professionals who are experienced in those asset classes and they're managing your money. The best scenario I can give is when you're investing, say, in a mutual fund company and you're relying on that investment broker or those fund managers to look at the investments that match your risk profile and then put that money in the best place for you, whether it be higher, more aggressive returns or something that's more conservative. Just like that, you have real estate, you've got some projects that are really aggressive and some that are more conservative, and you figure out what makes the best risk for yourself. So for general partners, and this part of the slides are really going to be more focused on some of the investors who are looking to be involved in the general partner side and what those benefits look like. And then also what to expect from a limited partner with a general partner managing your money. And there are a few different fees. And again, these are, I'll say, very general fees. They fluctuate a little bit, and every deal could be a little bit different tolerance on one or the other. And not all of these fees are on every deal, and some deals have more fees that are not listed here as well. But these are pretty normal ones. You'll see a couple points for acquisition. This is when you're buying the project, you have an asset management fee. This is something that's typically billed or earned every month as the project goes on. Just think of it as the money's coming in. That piece is an operating cost. And then in some cases, you'll have loan guarantees for people who are actually sitting and guaranteeing on the loan for the project. And then a disposition fee. This is very similar, akin to like a realtor fee as you close the project. It's the same thing, but it's more focused on the work and due diligence the general partners are doing is finding your best exit. And then in the cases of real estate brokers or agents, there's sometimes opportunities for commissions on those sales as well. So that's something that could be on the purchase and the sale if that's the way the deal is structured. The main thing is, do the deals work for the general partners and limited partners, or is there enough meat on the bone, so to speak, to where each side is making a good return? What are some of the roles in the general partners? So you got like an acquisition manager. These groups, you might see somewhere in that 20% range of that general partnership. So everything we're talking about right here is that 20 to 30% of the project. So you're going to see a group of general partners. It could be a single entity. We've done several of these projects where we're the only general partner in the mix, where we're doing everything from guaranteeing and acquisition management. Or you may see different companies doing each part of this, especially on the bigger deal. You may have some due diligence costs. And again, these are rough numbers. This could always fluctuate as well. 15 to 30%, for example, for key principals or sponsors. This one varies widely. It's just really how important is that person in the project, and how important is it or how strong are you already on the loan guarantor as if you're a general partner? And basically, how much do you need that key principal to guarantee the loan or to be on the loan to make it happen? Investor relations, this is really geared towards your limited partner fundraising. So a big part of this role is bringing money to the table. This will also bring up a kind of, it's important to note here that people who are in that investor relation part and they're a big function of their job is to bring money to the deal. That can't be their only function. They've got to have some other function within this partnership aside from just bringing in money. Otherwise, they're just, they would need to be regulated by the SEC as someone who's like an asset manager or fund manager or something like that. And then lastly, 35% for asset management. This is basically the operating company, the group that's overseeing the property management, maybe coordinating project management for a bunch of rehabs or construction. And again, this number fluctuates a bit too. These last two I mentioned specifically because these are really important, or I highlight these two because these are really important with regards to dealing with your investors and the things that you've got to pay close attention to and keeping yourself, one, out of trouble with all the three-letter agencies, whether it be SEC or IRS or any of the other bad ones that you don't really want to deal with from a government standpoint. But they're really important because they do have such a big impact on the success of the project. On that note, quick legal disclaimer. We're going to talk about a couple of things on the regulatory side. Not a lawyer, not claiming to be. This is all information purposes. So certainly seek legal advice if you're diving into this yourself and want to get the right answers. So right off the bat, yes, you are, if you're doing these syndications, you are selling securities. So there's a couple ways that many of the syndicators will go through. Both of them use, we call this Regulation D, Rule 506. And basically, it's just an exemption that they allow for certain of these real estate investment opportunities to be able to operate without having to go through full SEC registration. A couple of things, for example, providing the private placement memorandum and then some ongoing compliance requirements. These are steps that you have to make sure that you're doing properly, and again, get your legal advice and help through the project to make sure those happen. But that really falls into two main flavors. 506B, think of B as your buddies, your friends, family, and these groups. And on those raises or projects, you're going to have a certain amount, and I think this is all still up to date. You can have a certain amount of accredited investors, unlimited amount of accredited investors, and then up to, I think in this case, it's 35 non-accredited investors. The big thing with this is you cannot advertise, or no general solicitations. You can't post this out on Facebook or the web or blast it out online or radio ads or any of this stuff. This is only for people you have a pre-existing relationship with. That's a little bit of a gray area. Some people will say 3 touches. Again, talk to your lawyer about what is a substantive relationship to have had before these people can invest in a project you're doing. And then on that, it's a self-certification for your accredited people. You can take an unlimited amount, but you don't have to go through a third-party accreditation in those cases. So the other is 506C. This one is where you can advertise. You can blast this out over the airwaves, wherever you want. And the limitation, though, is you're only able to take accredited investors in the project. So in this case, if you had, $1 million to raise and you just didn't feel like you had enough friends and family that could do that, you could still have some of those people who are accredited invest in the deal. But if you're going to be advertising this deal, you can only take the accredited people. So you're going to limit the number of people who could invest in that type of deal, but you're also broadening the number of people that you could reach theoretically by advertising and reaching out to ones that you don't know. So it's a kind of a trade-off, and you'll see a lot of people who do a ton of stuff only in 506B, and then a lot of people that do a bunch of stuff in 506C. There's people that are successful in both. I'm sure there's some good statistics out there on what type of projects tend to go one versus the other. I don't have access to those, or I haven't looked into that. But the main thing is this is really where most of them fall into. There's some other some exemptions regarding some of your cloud services and capital raises. crowdfunding. I don't know much about those. I really know or been involved more with the 506B and C. Deal sourcing and due diligence. This one's it's different for some of the people, and then a lot of it's going to be the same. A lot of the people that migrate into syndication have been involved with single family, some small multifamily, and the question becomes, well, how do I find these bigger deals? How do I do the due diligence and underwrite them? Are they a good deal or not? And that's why I've got this picture of a bazaar here. Is sorting through what's great and what's crap is a tough job, and there's going to be a lot of it, and there's going to be a lot of people out there telling you, oh, this is the best thing since sliced bread, and this one's awesome, and you're going to be rich, and blah blah blah. And it's no different than the single family world. It's just harder to sift through a bit. So a lot of your groups that you reach out to are really the same. You're going to have some commercial real estate brokers. So there's be a little bit different ones you probably don't deal with as primarily investing in some of the smaller properties, but there's several of these brokers that will be advertising properties. You can get on their mailing list. You can be involved in their meetups, networking industry events. This is where my wife, Sherry, she hosts a big networking event in the DFW area. And so she does that every month. There's other people that do events that are similar. And it's a great way to find, get out and meet people. And there's people oftentimes that they're doing deals or working on projects. They're working on a project maybe they're raising money on. You can be part of that. So there's multiple ways to be involved and learn about the deals that are going on. Even talking to real estate agents, even though you wouldn't think of them typically as dealing some of the bigger commercial projects, they still are involved. And even if it's not something they're directly listing, they usually have their arms around what's going on in some of the areas where they have counterparts or other people they work with that have access or knowledge of some of the projects and deals. For you wholesalers out there, this part is something that it's still a viable option, is some of that direct marketing, wholesaling, inbound lead companies. There's some that will focus on projects maybe that are a little bit bigger, big land deals that you might syndicate a land deal or development, RV park. So there's a lot of different types of projects you can source, and this is another good option for finding some of those deals. And this kind of goes back to your networking. You're talking to your lenders, attorneys, consultants. These guys, they're going to have other clients that are involved in this, and the more you just reach out and ask questions as you're talking to these people, hey, you got any guys that are working in real estate, working in land development, working in apartments, working in retail, industrial buildings? Just there's a wide variety of places, and you can really touch on any of those. And then social media. This one's always good. You see tons of crap on Facebook Marketplace. It's I end up with stuff I always have to go pick up for Sherry all the time off of Facebook Marketplace. So, but we also do see we've had properties that we've gone through and looked at and evaluated, and several of those. Don't know that we've purchased any off of there yet, though. We've had some offers that we've gone out on them. So there's some good deals to be found on social media as well. So it's one of those that people feel comfortable putting the stuff out there and marketing themselves, and not feeling like they don't have to go through a broker or real estate agent. And so it's a good source for finding some of these deals. So we're talking about the modeling and deal analysis. A few terms that are a little bit different than we see, especially in the single family space. We're gonna talk a little broader on the pro forma and the risk analysis. And when people are talking about pro forma, it's at its simplest, it's just like it says here, just creating a realistic projection for the project. This is where you're going to get in trouble a lot in believing the pro formas that people will send to you. They and to their credit, they do this nice, very neatly presented, detailed pro forma. It runs out 5, 7, 10 years or what have you. It's very rosy-eyed in most cases. Some of them will give you much more pragmatic views, and I think you'll find those you'll probably have a much better comfort level with. And then it varies from each individual person as well. And then what you have to do is just look at those assumptions that they make in their pro formas and figure out, okay, what is that risk of these? Or were they pretty aggressive on these assumptions and not really enough on those? You do your own property evals and marketing analysis. they may be saying that, well, we're going to get $1,500 of rent on all these 2-bedroom apartments, and you know that you're not going to get more than 11 or 1,200. Well, that's quickly going to go and adjust your numbers for your pro formas. So really no different in that regard to what you'd be doing on a house, a duplex, quadplex. You're just now scaling that up into a bigger picture. A couple of the terms that are more specific, especially in the bigger deals, are going to be cap rate and NOI. Cash on cash is going to be, well, let me backtrack, I guess, here. So cap rate and NOI. Cap rate is a way to get comps or to help you with comps for an asset that doesn't have a lot of, or I'm sorry, defining what appropriate rates are where you don't really have a lot of comps. Like houses, you can say, well, how many 3-bedroom, 2-baths is sold in this 3-mile area? And you say, oh, it's this many. Here's a comp. I've got 50 comps. Well, now you're buying a 100-unit apartment complex or an RV park. When you start looking at the same area, there's no way to grab comps just in that same manner. So regionally, what kind of happens, and you can spread out that region as much as you like, is you look at cap rates. And basically what that is, it's a factor of your net operating income and what you're purchasing the project for. So in this particular case, it's looking at the previous deals that have sold. Maybe there hasn't been any 100-unit apartments that are sold, but there's been some 60-unit and 80 and 120, 150 and all these. And what they found is that when you look at the net operating income of all those and then what they sold for, then you can kind of get an idea. Okay, the cap rate in this area is, let's say it's 6.5%. That might be a decent cap rate right now for a project. So when you're buying these deals, you really want that cap rate to be as high as possible. So you're looking for a cap rate that's high. So when you think about the value is just your net operating income divided by your cap rate is what gives you, in that case, the sales price. Or if you're looking at a sales price and divided by your NOI, that gets or NOI divided by your sales price gives you the cap rate. So those are the numbers you want to kind of look together. The cap rate kind of ties multiple properties together in an area. Cash on cash is what people are going to be looking at as far as returns, what a lot of the LPs are going to care about, what kind of cash on cash returns am I going to get? Equity multiple, this is one that I tend to steer towards a fair amount. And at its simplest, this is just how many times my money am I going to get back? So if I see an equity multiple of 2, that means I'm going to get twice my money back. So I'm going to invest $100,000. When the project's over, when I look at all my payments along the way, and then the sale of the property, I will have gotten back $200,000 if the equity multiple is 2. So it factors in all the money you've gotten along the way, and then you close the deal, and that's my equity multiple. So obviously, the better the equity multiple, and the shorter amount of time is better. But most of the time, you'll have a project period that, let's say it's 4 to 6 years, and maybe they're targeting 5 years. A goal for a lot of people is going to be somewhere in that 2 range. So can I double my money as a limited partner? Can I double my money in 5 years? And if I can, then that's probably a return for me anyway. That's a return I like. And this other, the internal rate of return, they kind of correlate here. Whereas internal rate of return looks at the time value of money. So if I say in the same scenario, I've got a deal that's 5 years, and I'm going to get an equity multiple of 2. The time value of that money, that would be like me taking money now and getting a roughly, I think 16 point something percent IRR over the period of that. So it says if I made 16 points, year 1, year 2, year 3, year 4, year 5, at the end of that, I would end up with double my money. Now, if that was a compressed timeline, that would be even higher IRR because I've got that money back much faster. And so I'm not going to spend a huge amount of time on that. It's certainly one that I would recommend you guys get comfortable with and looking at the deals. The main thing with both of those is equity multiple. Think of it as when the project's done, what times your money you had going in are you projected to get back? So equity multiple of 3, triple your money. 1.5, you're going to get your money back plus 50% more. And so you look at that compared to your timeline, and then there's a correlation there between the IRR and that equity multiple over time. So a specific case study, I just grabbed a unit. I'm not going to talk about what case study this was or what project, but this gives you an idea of something that's in the area and what was provided. So in this case, it was 77 units, 823 average square foot per unit. And then the pro forma projections over on the right side. So you see the current market rents in here, and then over here, the pro forma projections. Now, these aren't really that bad. There's a little bit of increase in the price, and they'll talk about in this particular case, they talked about some of what you would do for the enhancements to get to that. But we're going to use these, and we're going to treat it as if the pro forma numbers they gave us were accurate, and that's what it would return, so we can evaluate this deal and see what we think. So in this particular case, we're saying that we've got a $3.5 or $3.3 million of enhancements at a 6 cap rate. So they're probably looking at 6 or 6.5 cap rate as far as what they're trying to sell it at. And in this case, this is where they're going to say, we're going to spend, say, $400K here, and we're going to get another $16K of monthly revenue. And then over the end of the year, we get 201,000 extra. That's how they come up with this 3.35 million number here. It's just taking this, dividing it by 0.06, and then getting this. So we talked about before, the value or price is the NOI. In this case, it's the increase in rent divided by the cap rate. So as you increase the rent capability, the value goes up. And in this case, their assumption is the value would go up by 3.3 million just as soon as you did these enhancements. This is coming off their pro forma, and you get an idea of what they're looking at. So this is some of the stuff you would see or expect to see on this. This talks about some of the change. I wasn't real concerned about this part, but this right here is what we're really looking at, this T12. What was happening the last 12 months? In this case, it was important because if I'm going to a bank and saying, I'm going to buy this property, it's X million dollars, the first thing they're going to look at is what's it making now? It's 587,000. Okay, well, if I'm going to look at this and I'm going to buy it at a 6.5 cap, well, what is that? It's somewhere around 9-ish, somewhere 9 million or so. So I think I've got the number in the next couple of slides. But this is what you're going to look at as you evaluate this deal. Let's assume, and we're assuming all these other numbers are right and kind of in line, and nothing's kind of wonky with what's being shown here. So this just kind of gives you an idea right away. So if we're going to buy this and the market is okay with the 6.5 or 6 cap, well, then what does that deal look like? And so we'll run through some actual numbers, like what you might expect to pay for this property. So we did a couple of assumptions in this case. And so some of these are a little bit old, but the rates are a little bit better now. But like in this case, we have a cap rate of 6%, some senior debt of 8.5 at a 20-year. I believe you can get better terms than this right now, but for sake of argument, this gives you an idea of a particular option in the lending. DSCR 1.25. So they're going to want to see at least an ability to cover the expenses plus 25%. And then I'm looking at this deal when I'm looking at the numbers and the benefit for the limited partners, a 5-year hold period. What does this look like if we exit the deal at 5 years? And I believe in that case, I have the exit cap rate also at 6%. So I'm not going to make any big assumptions that I'm going to buy it at 7 or 8, and then I'm going to sell it at 6, which would be more in my favor. So a really pragmatic view. So the actual NOI, 587. If we do that 6% cap rate, that would mean the value of this thing is right now is 9,786. And that's assuming that this is the current kind of market rate, that this is an acceptable market rate. Now, I'll tell you, you don't want to go in and pay this if you can pay 6.5 or 7% cap rate, certainly. But this gives you an idea of where you might expect some of the value. And if the area happens to be you're in, you see a lot of the properties that are selling for lower, 5.5% cap, well, then shoot, 6% may be a great deal. Now, if we look at the pro forma on there, you see a big difference here. 702, that would have a value of 11,701 or 707. This is one of the big reasons why you have to pay attention to the actuals and not get too enamored with this pro forma. Sure, this is what you'd like to see later. Once you've got the property and you've increased the value and you're doing some of the stuff, it might give you some insight into what you could ultimately get out of it. But if you go in taking their assumption, say, I'm going to buy it off a pro forma NOI, which you should never do, you're going to be paying almost or in this case, exactly $2 million more than the property is currently worth. And that just shows you the difference. If the cap rates were lower, like in this case, say 5%, you'd see how much that impacts it. So cap rates are really important. So it's certainly to your benefit to understand what the going cap rates are for the other properties around the area. And again, those are basically your comps, seeing what other places are selling for and what you can get away with, because you certainly don't want to be paying a lower cap rate than you have to. So what I did is want to give some real numbers of what this looks like. So if we played this thing out and we said we're going to purchase this for $9.7 million, and in this case, would actually have to put close to 45% down, not because of raising money or anything like that, but because in order to get to this 1.25 debt coverage, I can only borrow 55% of the value. So the lenders may loan 75% loan to value or 65, 70, somewhere around there, but they're still going to limit you based off your debt coverage ratio here. So in this case, it only can get to 45%. I'd have to do a raise on that project then of somewhere around 4.7, 4.8 million. And my returns in this case are going to only be around like the 11.53 IRR. And again, that's assuming 5-year return and then an equity multiple of 1.7. And as I mentioned earlier, a very loose target for a lot of people is get to that equity multiple of 2 in the 5-year window. You can see here I'm falling off of that a bit. Still not a bad return. I mean, the 11.53 is certainly better than you're going to get in average stock market and some of the investment options that you have out there, but there's also more risk associated with it, or a different type of risk associated with it too. So I would say you're going to have a hard time getting many investors to be excited about this, certainly in the multifamily space. And just so you can see what that would look like if you did this now at a 6.5 cap, all of a sudden this deal looks a lot better. Now you're purchasing it 9 million, 40% down, only have to raise 3.9. Now we get an equity multiple around 1.99. So in this case, the same project, if you can purchase for 9 million, 6.5 cap, now this deal starts to look pretty good. So what does that mean for a GP? And this is always a question. Well, if I'm doing this and as a general partner, I'm going to spend all this effort. Well, how do I actually make money? And we talked about that before with the different roles a GP has and how it would break out for each one of those parts. And so I'll take a little bit of a look at this. So, we're going to have a purchase. We'll have an acquisition fee. We talked about that, maybe 1 or 2%. So off this front end, we've got $180,000 in this acquisition fee. Asset management. This is effectively this is a yearly asset management. So we're talking about 143. It's the percentage of what's coming in every year on this deal. Cash flow from the splits. Unfortunately, I don't want cash flow from that, but from the splits, just to give an idea of if we're making X cash every month and we do an 80-20 split, I think is what I did this one at. So 20% of that would be looking at for cash flow on that for over the period of that term, that 5-year period. Disposition fee. This would be that additional 2%, but it's 2% based off of the new sales value, which is going to be a little bit more than it was when we purchased it for. And then when it's all said and done, what's the 20% value of all those profits? So in this particular case, we take whether it be 3 or 5 or 8 people involved with this general partner or companies or whatever, the entirety of the GP in this case, over the period, this 5-year period, would have around 1.1-ish million. And then again, this is assuming that that acquisition and that 6.5 cap. So some good potential here. Now this would be divided up amongst usually several people. You got your raise, your guarantor, and all those things. But for each of the people involved, there's certainly some potential for some decent revenue. the key thing to note, especially for you guys that are only really looking at limited partners, this stuff doesn't happen if the deal doesn't profit. So for example, we look at this, the GP split of sale here, this cash flow, asset management. If there's no money here, asset management, you'd have some, but especially this piece here, which is really drives the bulk of all this. This doesn't happen if the deal is not profitable, because you got to pay back the limited partners first. And this only happens on the profit on top of that. So the deal doesn't work out well, the GP doesn't make money. So for those people, that they are all risk in that scenario. And so, but the good opportunity is it's an opportunity for people who are willing to get involved and do this part to be able to scale up pretty well. And that is it. So if any of you guys have questions, I appreciate you listening in. Hopefully I ran through that quick enough and it wasn't too painful in the details. I am certainly available for questions if you guys want to reach out. Believe this goes to one of our websites that you can reach me directly, but if not, you can contact me directly at Mickey@GorillaCapitalPartners.com, and I'll make sure that's in a link on here as well. Thank you guys.